Okay, morning everyone. David, thanks for the kind introduction. Yes, I'm from the financial world. I'm an equity analyst. Spend all my time looking at oil and gas, and particularly oil services. It's nice to spend some time with people from the industry, even if I am the person in the room who probably knows least about the industry, but I'll try and gloss over that and won't mention that too much. Now, I look at all parts of the oil service chain, seismic, drilling, subsea, flooding production, but particularly today I want to focus, obviously, on the flooding production sector and to talk a little bit about how we see things panning out over the next few years, what we see as the big lead indicators, and also what went wrong in the last few years and why certain things, if they change, might be a really good point for the future. So this is what I want to run through today, just a quick little agenda. I want to go through to quote our friend Mr. Rumsfeld, the known knowns and the known unknowns about this industry right now. What do we really say? What do we really know is happening that should point us towards a bit of a rosier next few years? I want to focus a little bit on also what went wrong in the last few years, and hopefully finding out where we can get some solutions to some of the problems that the FPSO industry has faced. Spend more time going through the opportunities, looking at deep water, looking at floating LNG and so on, and then just a very quick wrap up with the obvious risks that face the market right now. So, on to the known knowns. What do we really know about the offshore world right now that we can draw on? Well, firstly, there are more of these around, more of these nice big subsea vessels. There's been quite a substantial supply growth since 2009 and 2008, and there's more coming. So some of the machinery to do the complex installation work you'll need to go offshore is certainly increasing, so that part of the value chain looks better. What else do we know? There are a lot more of these around, a lot more supply vessels. Now, if you own one, you might think there are too many around, but in that picture, there's clearly, if you like, the grease that should oil the wheels of offshore work is also getting a bit more prevalent in that space as well. Most importantly, though, is this. There are more of these. There's a substantial increase in the number of deep water rigs, semis and drill ships over the last few years, and there's more coming. Now, this is worth looking at in a bit more detail, because this is a key part to telling us how the offshore space will grow in terms of development and exploration in the next few years. So these two little charts here, this is the overall number of floating rigs in the space, so semis and drill ships, and this is the year-on-year growth. So you've seen some pretty decent growth. From here, there's another 25% coming by 2016, and actually comparing where we are by 2016 with the end of the last boom period, 2008, we're not quite, almost doubling. And this is clearly a good sign that there's a fair bit of additional assets coming to work in this space. Now, this was a bit of a bottleneck in the last cycle. It still is hard for people to get hold of the right rigs, but it feels like the bottleneck is certainly easing in this respect, and there should be, it should be a key part to enabling the offshore sector to do more work. The next known is just to give you the impression is Subsea. These are the Subsea companies, the installation, which is the red line, and the equipment guys. And this is the backlog they report every quarter. Obviously fell a bit after the last peak, but now doing pretty well. And actually, it's a rather similar level of growth that we've seen for the drilling sector in this space as well. So almost doubling from where we are now versus when it sort of bottomed out in early 2010, and currently up 20% year on year. A healthy sign that projects are moving forward and there's development work moving on. And there should be another good indication. And if we look forward, this is from our friends at Infield Systems, just a projection of the regional capex that's expected to come through in Subsea. And I won't go through this in a huge detail, but if you look at it, there's some interesting trends. Firstly, the next 5 years are roughly double the last 5 years, so there's good growth in prospect. Africa becomes very important. Also, the Western world is very important as well. You add up US Gulf and Europe, you're not too far off Africa. And this tells you that there's some interesting mixes that come up. Everyone knows Africa's full of political risk. If Africa, for some reason, sees a lot more delays in the pipeline, then you better make sure you have a good, if you're a subsea contractor, for instance, make sure you have a good footing in the Western world, because that's your cushion. If you don't have that, and all your eggs are in this basket, which is the case with some players, then then the risk profile the next few years is probably more risky than you actually think. But in general, it seems to be a good indication that plans are really moving ahead. Now, there's one theme, I won't go on this too much, but it's an interesting one to throw around. We get a sense from the oil companies, the big ones especially, that this time around, although everyone's very busy and fully utilised and everything, there's actually a lot of competition out there for the extra capex dollar. There's a lot more opportunities and choices than there were perhaps in 2007 and 8. Unconventionals is a big one, of course. Mexico opening up, Iraq opening up, China shale. There are quite a few things out there that mean that the pressure to do any one particular theme when you get to a board level decision may not be quite as intense as it was back in 2007 and 2008. And I think this is one reason we are a little bit more nervous that, we're not concerned, but we're a bit more nervous that some of the deep water developments could be at risk from this. But let's jump on to the next section. This one more last thing I forgot. It's more of a known unknown than a known known, but one very simple PR comment for this industry is that there's been a good, decent run of exploration success in the last few years in deep water. Now, most people in this room know this better than I do, but and I've heard this discussed many, many times in this room. Normally I last for the first two sessions, and the sessions 3 and 4 are way above my head. But in this particular theme, the fact that there's a good pull from exploration success in some key basins, pre-salt Angola and so on, and East Africa, is good. It helps those discussions at a board level to move ahead with the oil companies. But I won't go through that in too much detail. So this all looks very good. So I guess the question is, will this work? The question is, will the pointer work? Hang on. Yes, there we go. The question is, really, what went wrong? It all looks pretty good. If you look at the rig count and look at the subsea plans and so on, and the oil price especially. But what went wrong? Because clearly the last few years have been somewhat disappointing. This is the famous YEME platform, or as someone called it, the Why Me platform, which makes a lot of sense. This has caused, as you know, a lot of headaches for both operator and contractor alike. The big thing this results in is this, and it's a huge mismatch here. This is the subsea backlog, so if you like, an overall indication of health of the offshore industry. And this is the average FPSO share prices of all the ones that are listed. You put them all together, start at one here, and you end up, there's been a bit of recovery, but it certainly has underperformed. And look at this in a bit more detail. So here we are, share prices again. So even after this sort of 6 months of recovery, which is SPM sorting out why me, it is BW Offshore recovering and a few other things as well. Even with this, you're still almost down 50% from 2007. Valuations, looking at price to book, which there are lots of metrics, but this is just one, hasn't really got going either. So this whole group, in terms of leasing operators, has really been derated by the financial market after the problems they've had in these years. Now, I don't intend to list these, because if I do, the list is long enough to make us miss coffee. But there's a mixture of internal issues and benign ones. The benign ones are just the cycle. So there have been delays post-Macondo, a lot of redesigns, the usual politics, and of course local content challenges. But also you've had a lot of issues in terms of, put it bluntly, poorly specified and badly executed vessel construction jobs. And this has really this has delayed the onset of production materially for the guys involved, and also led to very big write-downs, and has pretty much trashed the financial performance of the guys who've been leasing in this space here. So we jump on to the next one here. No. Batteries. Oh, there we go, excellent. So given that opportunity and given these challenges, is there really much to go for? We think there is. Modex certainly think there is, a nice vessel opposite offshore Rio here. But we think there is an inevitable reaction to this offshore cycle, in that after many tumbles and stumbles along the way, there will be a good opportunity for the FPSO sector ahead. Now, I guess it's just worth noting why, echoing David's comments right from the start actually, why this is still popular. Why do people like doing this after all the problems? Well, there's a lot of comfort with the idea, and there's a lot of experience of people who've handled FPSO type developments. So there's a lot of experience, and that always helps in this industry. There's also this benefit, this chart here is a chart of returns, IRRs, for a theoretical offshore project, probably a little bit too strong in terms of the actual value along here. Maybe you could take 5% off that for the current cost environment, but nevertheless, that spread is there. So in pure financial terms, leasing it does help your IRR, and also, of course, if you're a smaller company, leasing it means you don't stump up with a big capex. So there's a lot of attractions from a financial point of view of looking at this development as well. There's also the environment is getting a bit better in terms of the loose cannons that were around in 2006 and 7 and 8. So have been disappearing. Quite a few guys have disappeared, some have been acquired. The list of companies that do this now are the more experienced players. And in the background, of course, you have quite a good cost environment from the whole point of view, because the yards are, depending which way you look at it, half empty or half full. They're quite keen for new work. So there's a fair, from at least this side of cost, without looking at top sides, this side of cost is quite supportive. Working now. So this is a simple view from our friends at Bumi Armada over in Asia of the global FPSO picture right now. Now, you're not going to go through every single one, obviously, but just as an indication, give you a flavour of what looks to be on the horizon. You got, I'll mention this in the next slide, roughly 60 jobs, but there's a bunch of stuff in Asia, many of the smaller projects, larger ones in Africa, the ubiquitous Brazil after the 2-2 draw, and a few other smatterings of jobs in the North Sea, US Gulf, as David mentioned, opening up. Maybe even Mexico, they're tendering for work there now for some shallow water FPSOs. That could be an interesting market, and things never happen quickly in Mexico, but the potential is there. So this looks like, it doesn't look too bad. It looks to be a fair smattering of work on the horizon. If we look at this in a bit more detail, this is SPM Offshore's view, the top chart here, of the outlook. So again, there's a big chunk of stuff in Africa, there's a fair bit in South America, and a fairly good chunk in Asia and Europe as well. Now, actually, if you look across all the companies, you get rather different views on this, and there's a timeline issue. Are you including the probables that are perhaps 3 or 4 years away, or do you just look at the ones that are really on your sort of 1 or 2 year horizon? There's a bit of definition issue here, but nevertheless, there's a fair chunk of work out here. So roughly 60 projects. We did our own sum up as well, and you come up with roughly the same number. A bit of a different split between lease and build, and a bit different split between some regions, but you get roughly the same number out there. Roughly half lease, and the rest of it probably is build, but it remains to be seen. There are some challenges out there, though, and I think this is one of the key things we feel for this whole industry right now, is the activity looks to be quite good on the horizon, especially if you start following the rig count and the subsea backlog growth and so on. The challenges are really that the mix is quite different. There's some much larger vessels to be built. This is the converted topside weights from SBM again, the Brazil stuff with this top end, over 20,000 tons, and larger ones to come. So there's a complexity and size issue. There's also quite a different choice about lease versus own, given the financial environment and how easy money is to get hold of. The conversion versus new build as well. Now, some companies have been rather against converting for all the usual safety reasons. Actually, we found quite a few of the big guys have been getting more interested in it recently because of the time schedule, because you had these things delayed for so many years. You now got a chance to choose between maybe a 3 or 4 year build or maybe an 18-month or 2 year conversion. VLCC prices or ULCC prices are pretty attractive, so why not look at that? So there is more interest in that, which again shifts a bit the balance of power from the oil services side in terms of who does it. Do you lease it or do you just get it from a yard? So there's some quite interesting changes there, really. You jump on to the next one. This is just a snapshot again of a regional picture from our own measure of this. I guess what I'd say about the regional split is just that Asia, although numerically there are quite a few jobs on the horizon, we're always a bit more concerned that that market remains more competitive, simply because there's a lot more who you know rather than what you offer that tends to drive who wins the deal. So regionally, you find that the regional winners or the regional champions tend to take a large share of the work. It's also a bit of a lower quality as well, or lower specification work. But in general, as I mentioned, there are some different themes out there. The thing that really strikes us is that if you look at growth, look at the growth prospects for FPSOs overall right now versus the view from 2007. In 2007, the view was, well, you could hardly see the view. The horizon was obscured with all these nice lease jobs. Now, a lot of those never happened. But the picture now is there could be a lot more work for the shipyards. There could be a lot more build work coming, more conversion work coming. And actually, it's pitching a bit of a different competitive environment from the contracting side, where the FPSO specialists are really also lining up against all the shipyards and offshore EPC players like McDermott and so on, who want to try and build these on site or in the right region in China or in Asia, etc., in places around the world. The other one is also that's popped up just recently, is there seems to be more of an interest to explore oil companies taking, if you like, a more serious stake in the actual lease project. It's saying, well, you look at the last 3 or 4 years, whenever we've had a big lease job, they tend to have problems. So why don't we invest maybe 20, 30% in it and be in the yards 24/7 alongside the guys converting it or building it, just to make sure we're fully on top of the risk of this happening. And also to be able to manage any changes that come up in terms of some field specification change or some oil quality change that means we have to redesign the topside. So we're feeling that there's definitely interest in the oil companies getting much closer to the FPSO guys themselves in this. Two more wild cards, and I won't go on about FLNG too much because it's a bit of a long shot from this one, but subsea side of things. So we're not there yet, but in the next few years, We know there are quite a few plans out there to look at basins that are starting to become a bit more mature in terms of the number of developments in the water or on the water, whichever way you look at it. Is there enough infrastructure to start tying things back? If you can handle 60, 70, 80 kilometres, even 100 kilometre tieback on a 5-year view, there's probably a lot of stuff in Africa you can tie back, West Africa, you can tie back to some existing developments. So maybe that disconnect we saw earlier between the Subsea backlog and the FPSO share price performance or valuation, whichever one you look at, maybe that actually does have some grounding, and that if you look at the number of Subsea developments, maybe the number of FPSOs you need isn't quite the same. Maybe it is actually a little bit different. FLNG has been coming for 20 years. It is now coming. If you ask some of the shipyards, they tend to tell you there's probably 4 or 5 coming this year. We don't follow that, and we think this is going to be a very, very long progression with everyone watching very carefully what happens with Prelude. But that's all I'll say about FLNG. But clearly it's a real big mover when it comes, but it's going to be a rather gradual move. So just one quick chat about the whole complexity thing, and just as a simple schematic, and we covered some of this already. The simpler, smaller jobs tend to be in this part, larger jobs here, and the most complex up here. But this shift all the way up, both in terms of the actual size of the vessel, in terms of handling associated gas, produced water, re-injection, maybe even looking at small-scale GTL to handle high levels of associated gas. There's a lot of additional stuff going on the top sides of these vessels now. And this is starting to bring into issue the famous cost question. Now, the hull seems to be fine. I think the yard outlook for pricing is probably relatively nice if you're a buyer. But when you add in local content for the modules and integration, you add in the drilling costs, which, although there are more rigs around, haven't really gone down very much in the last couple of years at all. For the overall development, you look at the penchant of certain oil companies to gold plate everything, and there's clearly some questions around here, which leads us to believe that engineers will be very, very busy. There's a lot of redesign work and a lot of trying to get these designs to do what they need to do, and not necessarily what they need to do in 20 years' time or something. But there are some clear challenges coming up here, and although the reasons behind some recent delays have been more reservoir issues, Mad Dog 2 and so on, there are clearly issues with cost, and we hear about this a lot at the moment. And anyone who can come up with a design that saves money and allows you to make sure that drilling cost doesn't wreck your entire economics of the field looks quite promising. Just to wrap up this little section here about the outlook. So again, this Subsea backlog picture, the bars here are the year-on-year growth for the overall total installation and equipment together. So 20% up year on year, almost doubling versus early 2010. So what do we see here? I mean, yes, we do see a good opportunity in terms of activity. I think there are quite a few questions out there as to what mix it'll be, whether there'll be more owned versus leased vessels coming up. If you'd asked me 6 months ago, we'd have thought there are clearly going to be more owned than leased. Right now, I think we're looking at a more balanced market, partly due to the fact that money actually is becoming more easily available. It depends a lot on who the contract's with. If the oil company is a reputable operator rather than a really new guy who's popped out of nowhere, then banks and other financial institutions, private equity and so on, seem to be more open to lend at the moment. And it's the chase for yield, it's a hunt for yield. And while that appetite remains, I think you'll see certainly the room to fund the lease development is getting a little bit better. So overall, I think we do see a few hotspots in Brazil, obviously, with big lease. There are certain areas, certain regions where the national champions will do very well. Shipyards will benefit a lot from the volume of work, although maybe not in the margin of it. And long term, we're looking at things like FLNG in Mexico too. But that's probably, to be honest, beyond the horizon of our view of the world, but it'll take a while to come through. So that's the overall picture in terms of an outlook. I guess just a quick snapshot, just to remind ourselves what the risks are and certainly how we see them ordering in terms of what holds back development activity and what holds back offshore work in particular. Now, David's mentioned a few of these already, but the volatility issue is always first on our mind. We actually aren't too worried about the oil price itself. Unless oil is going to be 50 or 150, we don't really care too much. And obviously it's got to be within the right range, but between 90, 85, 105, 110, so long as the volatility isn't too high, and so long as there aren't big issues with very weak Chinese demand or very high shale oil production numbers that scares the market and pushes oil too much the wrong way, we tend to think that it's just the volatility is the issue. And if that's under control, then the simple economics should work out. Just for the record, our feeling on this famous phrase, the unconventional side of things, we're not in the shale oil will swamp everything camp. We think it'll be rather a slower development. You've seen the best of it already. Decline curves will kick in, and the next wave of developments you'll see in shale oil in the US will be, the growth rates will start to flatten out a bit. Now, of course, there are other things behind that, and we can talk for hours on that, but we don't think that the oil supply position in the world is going to be wrecked by shale anytime soon. HSC, of course, is a huge issue. After all the tragic accidents in the US Gulf, anything similar, even on a much, much smaller scale, would likely push a lot of this stuff to the right again. Politics, enough said. Cost and supply chains, I mentioned that already. I think, the issue we just see here is this battle for the local content argument is a key one. It's often hard to get visibility on, but it's one that we think is a continual headache. And of course, this is starting to open up, and this is something we wrote last year as a growing risk, but it feels like that bottleneck is starting to open up now, with 40 or so rigs coming in the next few years. So that's the overall picture. Just as a very brief sum up. So what do we think about the world? We think that it is clear that there are certain known knowns out there. There are certain key, if you like, lead indicators that can tell you there are more rigs, there are more ships, there are more of the hard assets to do the actual work, and that should enable a lot more activity offshore to get going and to catch up with where it really should have been, both in terms of new developments and in terms of the stuff they should have done probably 3 or 4 years ago. This implies to us there's a good prospect list out there for the FPSO industry, although the waves will be realised. We think it's going to be quite different this time versus the last cycle. And we still think, we think the battle between owning and leasing and converting a new build and so on will one that will go on for many years. But the prospects, in terms of pure activity, the prospects for FPSOs we think look pretty healthy. We're still a bit concerned about the overall picture in terms of the risks out there. We think that offshore in general has quite a few question marks over the speed of which projects get awarded and come through. It's been quite a good year so far. We had 10 recently in Ghana. We've had some other big jobs in West Africa, North and Moho Nord and that sort of thing. So the larger jobs are starting to move, but the cost environment, both drilling and otherwise, is starting to raise a lot of sort of, I wouldn't say red flags, but certainly yellow flags. And that makes us think that some more of this work is likely to follow the usual pattern and move to the right by 6 months or a year or so. But nevertheless, offshore overall, we think is going to grow 10, 15% a year for the next few years. FPSOs, having been some of a laggard, are going to gradually catch up to this space and hopefully will provide the industry with a lot more work over the next few years. So that's the overall picture. Thanks for your time. I'm very happy to have a chat afterwards as I run the rest of the day. But thank you.
So we got time for a few questions. I'm going to start us off, actually. I mean, when I was quoting the views of some investors on maybe this is, majors and NOCs are not impacted by these views of developments being per se damaging. I mean, that was actually, I think, a view that says majors can fund developments from cash flow, and therefore, are not taking on debt to fund these things. But there's another aspect as well, which is, seemed to me that you were saying that, the customer, if you go back 10 or 15 years, there was a view that the customer could just stand back and leave everything to the drillers or to the FPSO builders, to the engineering companies. And what we seem to be learning is that unless the oil company has major expertise of its own, this isn't going to work to time and on budget. Is that a view that you would share, or am I? Please.
Yeah, for certain segments of the value chain, yes. I think you've got a mixture really. I mean, everyone's short of engineers, and we've seen two sort of, if you like, contradictory trends almost. The subsea industry appears to be having rather fewer touch points with the industry. In other words, they've been doing quite a good job. They can make trees, they can install them, they can install flexibles and so on. Fine, go off and do that. Now, the bit where there's more interest to try and control the execution risk is more the last phase, if you like, the FPSO, the floating production platforms and so on. It's more, because if you look at where the problems have been in the last few years, so the last 3 or 4 years, it's been more in this than it has been in the installation. There's been the odd dropped cable here and there and the odd lost tree, but in general, that's been fairly dependable. It's been more both in controlling the execution and also in controlling how you build something when you're not too sure how the field might actually end up, and if you end up having to redesign some of the top sides. And I think that that whole flexibility about how you actually do the whole development has been, is the bit where we're getting more of a sense that the oil companies want to get closer to the service guys. Funding-wise, agree on that one. The majors are, you look at, they're always very sensitive to their dividend payments, but their ability to pay and invest, it's not too far from where the current oil price is. There's a bit of a range, but 80, 90, 100, 105, probably things like Statoil at one end and things like Shell at the other. But you got some, there's some of these guys are they're all financially capable of doing this stuff. And actually something that stuck in my mind talking to Shell a few weeks ago was getting a sense as to how robust their capex spend is. There's $130 billion over the next 4 years, big numbers. That's based on $100 a barrel. If the oil price drops to 80 long term, that drops all the way to 125. So there's a lot of that. There's that spending there that isn't really going to change very much from their point of view, given some oil price movements within a certain range.
Okay. Please. Yeah. And wait for the microphone and say who you are.
Yeah, speak clearly.
Yeah, hi, Will Davey, advisor. Very interesting presentation. I noticed the focus on conversion and costs and obviously value and proving the economics of the projects is absolutely essential for these things. I noticed on one of your slides you said there could be scope for small-scale GTL. I was wondering if you could elaborate on that and what sort of size you consider to be small-scale.
Sure. It's an interesting little topic. If you'd asked me 4 years ago, I would have said the same thing. There could be scope for small-scale GTL. There have been a few, let me get this right now. It was a spin-off of the AEA, I think. It was a Compact GTL, which has been doing some work with, firstly with BW Offshore, and now with SBM in Brazil, and of course Petrobras. Can't forget them. But to look at the ways of handling all the gas that comes out of the pre-salt. Now, I think it's been changed a bit because some of the wells or the projects that have come on in the last 2 or 3 years have had rather less of a associated gas problem than they thought perhaps 4 or 5 years ago. But the next ones coming on do have more gas, and I think it's a very active discussion to handle, just to take that sort of maybe 20 or 30,000 barrel of oil equivalents per day and to convert it into some liquid that you can shove into the produced oil as well. Now, I don't think there's no need to lighten the oil as such, but at least it means that you can, if you don't need to re-inject all of it, and especially if you've got CO2 there, you can re-inject anyway. You'd rather use the gas to put it into the produced stream. As for a timeline, I have absolutely no idea, but it's certainly an active development. But I haven't got any hint that it's about to happen tomorrow.
Anybody else? Okay. Right. Thank you.
Right.
Thanks
Thank
again.
you. Cheers.